Hi, I'm Francois Trahan from the Macro Institute with a 10-minute voice blast entitled Goodbye Momentum, A Change in Leadership Ahead. The title doesn't sound like much, but I think the markets are staring, if not already, in the midst of a monumental event. And that's what I want to cover in this voice blast. Truth be told, this is really a bit of a summary, if you will, of the conference call that we will hold next week. If we look at page 2, you can see that there's a box there on the lower left to register for the call. We do a lot of calls every year. I think we did 8 last year. But this one, I really do believe is more important than typical. This is not just an update call. I think this one is really timely. We are about to see a massive change for the markets. So let me take you to page 3. The impetus behind this change has to do with policy. Typically, 2 to 2.5 years after a change in policy is where it starts to impact the markets and shortly thereafter the economy. So the chart here is an overlay of the yield curve and volatility. So the yield curve, of course, is a proxy of Fed policy. It's inverted on here, which makes it a little more complex, but the key point is that it is advanced 27 months. So smack in the middle of that 2 to 2.5 year range. And you can see that it fits pretty well with volatility historically. So if this thing was to be perfect, well, the peak in volatility that we would see for this cycle would be sometime in late September. And what changes after that is that we now have easier policy at our backs as a tailwind for the markets and, of course, for the economy. So these inflection points tend to be a big deal, particularly for leadership, and that's really what I'm going to be focusing on in this voice blast and on the call. It's not a no-brainer. I'm going to take you to page 4 and spend a little bit of time talking about the economic dilemma that we are all facing. All right, so on 4, here's the positive. The positive is that there's a lot of stimulus in the pipeline. I think most of you probably know that I'm a monetarist at heart, and so I'm going to be pretty excited by that middle chart, which basically just shows that money supply is recovering. That's what it typically does in the wake of rate cuts. And we have to remind ourselves that the Fed did cut rates by 100 basis points last year. So that's a big positive. To the left of that, we also have fiscal stimulus. Now, a lot of folks are very concerned about the state of the fiscal situation. That's not what I'm discussing here. What I'm discussing here is the impact that this bill will have on economic activity. And as you can see, most of it comes in 2026 and adds a little over 1 point to GDP growth next year. At least that's the estimate that we get. And then there's the longer term force of stimulus, which is what's happening to infrastructure spending, specifically as it relates to manufacturing. Some of that is related to AI and data centers. Some of it is related to reshoring, which I think is really what got this trend going. But these are 3 economic forces that are all additive for the economy. So that's the good news. All right, let's go to page 5 and talk about the not so good news. And all of it, one way or another, has to do with inflation. We have the tariffs, of course. Little clip chart on the left shows you that the tariffs are already having an impact on the earlier stages of the supply chain. This is the prices paid series from the ISM Manufacturing and Services Indices. Pretty good leading indicator of inflation historically. And so the chart argues that inflation from here reaccelerates. This is happening at a time when deportations are changing the makeup of the labor force in the US, also likely to be inflationary in some industries. And lastly, the longer term inflation story that we have has to do with demographics and the fact that it's almost impossible to lift the participation rate in the US economy. So we have a lot of stimulus, we have unprecedented headwinds, and one tells you that we're staring at a recovery, one tells you that odds are we're staring at a downturn. The best way to summarize these, I'm going to show you page 6. We use both interest rates and inflation as what we call anticipatory economic indicators. So we use these to try to figure out where the business cycle is going. Normally, 99% of the time, they're going to give you the same signal. And so if interest rates are telling you the world's about to improve, inflation's telling you the same thing. This is one of those rare occasions where they're giving you completely different messages. So on the left, here's the change in the 10-year bond yield that is inverted and advanced 18 months. And as you can see historically, does a pretty good job at forecasting. It's overlaid here with one of the regional PMIs, the New York Empire Fed Index, which did pop higher this month, by the way. And rates argue that this is going to continue. That's good news. Now take a look at the chart on the right. Similar chart, except that we're not using the change in rates. We are using a proxy of inflation. So this is the prices paid series from the Philly Fed survey. Again, it is inverted and advanced 18 months. This also just came out for the month of August, hit a new cycle high. And as you can see, this one argues that a regional PMI like the Philly Fed is headed lower for the next 18 months. That's the economic dilemma that I'm talking about. One set of forecasting tools argues for recovery, one set argues for a slowdown. I will give you my 2 cents in a little while as to where I think ultimately all this sets in. I want to talk about a couple factual things that we do know about inflation. There's a lot we don't know, and that ultimately I think we will discover, but I want to talk about some things that we do know. So if you look at slide number 7, the relationship between the US economy and inflation has changed. And I say this factually. And so the chart is pretty simple. This is the ISM New Orders Index, so proxy of economic activity, with the ISM Prices Paid series, a proxy of inflation. You can see that they tend to move together. But when you look at their relationship, so when you look at the beta of inflation to activity, what you see is it's gone up. So that's what that little click chart shows you. You see how we're roughly around 1.5 on that right scale there? That means that for every 1 point increase we see in the new orders index, we get 1.5 points in the prices paid series. So you can think of it as the beta of prices paid to new orders. And that ratio was below 1, well, throughout the 1990s and really through the GFC. It's really in the 2010s that it starts to trend higher. So we can factually say that mathematically, the US is more inflationary than it used to be. That much is fact. Another fact, this time on page 8. The biggest driver of underlying inflation or core inflation is labor markets. So on the left, here's core CPI and average hourly earnings. This is not anything novel. Core inflation and wage inflation have been correlated forever. But if you look at their correlation, you're going to see that right now it is almost perfect. It's almost at 1. And so when it comes to core inflation in the US, it's never been more about labor markets than it is today. I think everybody knows labor markets have always been important. They're just more important than they used to be. All right, on page 9, one more important thing to acknowledge. We know that in industries that are very dependent on undocumented workers, that there is a shortage of workers occurring. What we also know is that there's a shortage of workers in industries that have no undocumented workers. And that's the point I wanted to make with this chart. This basically compares job openings to unemployed workers in a number of different industries. In leisure and hospitality, there's a shortage of workers. I don't think that's going to surprise people all that much, but you can find the same thing in education and health services. And so the point being that this is not just about our immigration policy. There is an underlying issue taking place in the US that is related to demographics. All right, I'm going to end this little tidbit on inflation on page 10 by talking about why this is important. Because all of these forces combined are changing the textbook when it comes to inflation, at least as we know it. The reality is that economists of my generation never really had to deal with inflation, so we don't have a lot of experience with it. Over the last 40 years, it's been an issue at times, very briefly. It's never really been a major problem up until we got to the pandemic recovery. And I think some people associated that problem with the pandemic. The reality is that there's longer term forces, namely demographics, that are at cause here, if you will. So these issues aren't going away anytime soon. It complicates everybody's lives, including the lives of the folks at the Fed that I think have it not so easy this year. If you look at page 11, going to focus. And so the chart on the left, we publish charts like these all the time, which shows that the Fed funds rate historically has always been correlated with gauges of labor market tightness, if you will. This is the NFIB's single most important problem, quality of labor. And so historically, this series goes up. The Fed tends to be in tightening mode because it means labor markets are getting tighter. It means wage inflation will accelerate and vice versa on the downside. Here's what's weird in the last few months. And there's a number of these relationships that I can point to. If you look at a clip chart, we have seen payrolls slow. The last few months have been pretty terrible. And the revisions have been deeply negative. But while this is happening, gauges of labor market tightness, including this one, have actually shown that labor markets have gotten tighter. So employment is slowing, but labor markets are tightening somehow. And there's a lot of series I can point to in this regard. I'm going to show you one more on page 12. This is probably the most sophisticated gauge of labor market tightness. It's the Miller Labor Index. So it's a little more sophisticated than the typical stuff that you see because it incorporates other things. It doesn't just look at the unemployment rate. It looks at the prime age participation rate. It looks at the ratio of individuals that are employed part-time because they couldn't find a job. It's got a few other, bells and whistles, if you will. As you can see on the chart, pretty good leading indicator of the Fed's policies historically. It's not a perfect timing tool, but I think you can see that it will add insights on the Fed's likely behavior. And so you can see that it's ticked up recently. And the point I make with these is that the conditions that we had a year ago when the Fed was easing policy are not in place this time around. There's other things that you would argue, point toward the Fed easing, of course, including weak payroll reports. That would be a big one. Payrolls are certainly weaker than they were last fall. But at the same time, labor markets appear to be tightening. And what's happening with immigration policy, what's happening with demographics, let's be honest, is playing a role in this. So I don't think this is a no-brainer for the Fed. I think given Chairman Powell's comments this past Friday, it seems pretty clear that they will cut rates in September. I don't know that we're going to get 150 basis points in rate cuts here, as Secretary of the Treasury, Scott Bessent, has been arguing. So this story is still being written, of course. All right, so where will this economic dilemma take us ultimately? Let me take in page 13 and talk about this for a second. I think we are staring at a recovery, despite the headwinds. They're very real, But at the end of the day, when you look at cyclical factors within the market, they are currently adding alpha. And so if the markets is rewarding alpha, then in cyclical factors, well, that is a big endorsement on what's ultimately taking place, irrespective of the headlines on tariffs, deportations, etc. And what the chart shows, this is the relative performance of equal to cap weighted. So I would call a risk on factor or a cyclical factor, like high beta, like high vol, those types of things. They're all proxies of cyclicality. It's following the typical path that we see in regards to interest rates. So change in what we call our interest rate model is really just a change in rates. It's different versions of rates, combination of the 2-year, the 10-year, etc. But the key point here is that it's inverted, advanced, and well, these factors pretty much turned on cue. And so despite all the nuttiness and how peculiar this cycle feels, when it comes to what's happening beneath the surface, this stuff looks pretty darn normal. So it's clear we're staring at a recovery. It's not our run-of-the-mill recovery. I think it will be an inflationary recovery. And even in that context, it'll be a different one than we've experienced in the past. But I want to show you page 14. If you believe in this inflationary recovery story, I want to show you some stats. So this is really simple stuff. There's nothing very sophisticated here. But if you look at what the markets did historically, when the ISM is over 50 and CPI is over 2.5%. And there's different ways you can slice this. But I want to show you what happens to style. So this is just value to growth. Again, I would say a proxy of cyclicality, like many others. Value has outperformed growth every single time over a 50-plus year period when you have these conditions in place. And I think this summarizes what we're staring at really, really well for the next year or so. So we're going to spend a lot of time on this theme during the call. If you look at page 15, well, obviously, we always take our time translating what the macro forces tell us about ultimately factors or the micro. And we will elaborate on these 4 big macro themes and how to use them profitably within a stock selection framework. So the factor part seems pretty straightforward because that stuff seems to be working pretty much as it normally does. There's still a lot of open question marks. And so if you look at page 16, I pondered this one a lot. The composition of the S&P is very peculiar. And what I mean by that is that going into the GFC, the bulk of S&P earnings come from cyclical sectors, and the S&P had been a value-focused index for almost a century at that point. Now the bulk comes from growth. And so when cyclicals dominate the index, well, what you have is a stock market that doesn't do well when the economy starts to slow, but a stock market that does well when inflation is accelerating, because that usually comes in the midst of a recovery. When you have a growthy index, you're going to find yourself with a stock market that will actually be able to perform really well even when the economy is subpar. But you're going to have a stock market that will be absolutely allergic to higher inflation. Growth PEs are especially sensitive to changes in inflation. So it's clear to me we're staring at an inflationary recovery. It's clear to me that that gives us a lot of opportunities within the S&P. What's not so clear is what happens to the headline index. I don't know that this is a repeat of what we see in 2001, 2002, when we had the stealth bull market, if you will. So the index was down, but plenty of cyclical stocks were up double digits. I don't know if it's that extreme, but I do wonder if we have a lackluster performance in the S&P itself, but where the cyclical segments do exceptionally well. What's clear to me, and I'm going to end on that note, I went way longer than I expected on page 17, Same chart I had in the email, and so I'll leave you with this one. Here is the relationship between high momentum, and high momentum tends to be growthy historically. It tends to be dominated by risk off somehow. And it is plotted here with the yield curve, again, inverted, advanced 2 to 2.5 years. We are just staring at the point where this starts to turn. And so where all of a sudden, we now are going to have policy as a tailwind. And high momentum is usually what you focus on when you want to hide a little bit. And hence, it has some defensive or risk-off characteristics. It's dominated, obviously, by large cap growth, which is the bulk of the index nowadays. And so I think we are staring at a monumental shift in leadership. I hope you'll join us for this conference call. Again, I think this one's going to be very special. If you have any questions, do not hesitate to reach out. Trahan at themacroinstitute.com. Have a great day, everybody.